Hi, welcome to Parrot and Wolf. Today we're going to look at words and phrases in English that we can use to talk about business and money at an intermediate and advanced level. The advanced listening exercise contains all the key information and arguments you need to discuss business as a native, so good luck. Okay, so let's look at the first text for intermediate speakers. In its most fundamental and basic form, business is an agreement between two people to exchange goods and services of an equal value. Or more specifically, business is how you manage this agreement over time and transform it into a long-standing relationship that allows both people to prosper. This in turn leads to growth in the enterprise and employment for workers that creates wealth and opportunity for everyone involved. One might say the exchange of goods and services in trade is vital for a healthy, functioning society. Some goods and services are difficult to equate though, and finding the comparable value of wool in fruit, for example, is difficult without a standard that people can agree on. If you were to trade wool for fruit, then you need to know the quality of the wool and fruit before you can agree a price. The worse the quality, the lower the value, so the cheaper the price. The invention of money gave traders an intermediary that could represent the value of a number of different goods and services and also incorporate different levels of quality into the price. Money additionally meant you didn't have to cart around tons of oranges and wool, you could carry the money instead, which made trade even easier. The price of the goods sold is the money coming into your business and is called revenue. The total cost of manufacturing the goods, which includes labour, raw materials and distribution, is subtracted from the revenue to give the gross profit. Before you can take the profit home though and start spending it, you need to subtract the total cost of operating your business. That includes overheads, payroll, interest and tax. Once you've done that, you'll end up with the net profit, which is your bottom line and a true representation of the value of your business. It follows that one of the most effective business strategies for better net profit is increasing the number of goods sold while simultaneously decreasing manufacturing and operating costs. This sounds simple, but of course it's extremely difficult in the hyper-competitive dog-eat-dog world of business. Aggressively targeted and prolonged marketing campaigns can improve market awareness of a product or service and can consequently significantly increase market share, leading to higher revenue. Similarly, keeping operating and manufacturing costs to a bare minimum will also have the same result. The temptation for most business owners and chief executives is to do both and compound the bonus profit, but you need to be careful it doesn't affect quality. One of the highest costs for any business is payroll or staff costs, and by reducing this, you might not keep the expertise or numbers of workers required to complete the manufacturing process satisfactorily, thereby producing substandard products. Customers who have a bad experience with a product and then get poor customer support will stop using the company's products, which in turn impacts revenue. Running a successful business is a delicate balancing act that needs to react to market changes and demands, absorb lows and maximize highs, whilst maintaining a stable working environment for its employees and stakeholders. It's not for the faint-hearted. So that's the intermediate text. Now let's look at the advanced text. Financing a new business venture can be exhausting, although it's arguable whether it's a more arduous task than doing the same for an established enterprise. To borrow or not to borrow always depends on how cheap the money supply is, or more precisely, what the interest rate is. Whilst being a reflection of the inherent risk to the lender, the interest rate represents the appetite for investment in the wider business community. The debt markets aren't immune from competition on price, no free market is, so of course an institutional or corporate investor will always go where the rates are lowest, thereby forcing rates down. Unless of course no one is lending, in which case risk-orientated lenders can pluck a figure out of the air and ask, how badly do you need the money? Once finance is secured, hopefully at a favourable and affordable rate, the business can develop. Without the injection of cold hard cash for capital expenditure, you can't rent a new office, you can't buy equipment, you can't increase manufacture and you can't hit sales targets. It all hinges on the decisions made upstairs by the executive team and their aspirations. Too cautious and you grow too slowly, risking the competition grabbing a greater market share. Too reckless and you grow too quickly, overestimating the market share available and sinking into debt. In fact, tempering corporate ambition is analogous to balancing investments, which becomes even more challenging when considering cross-border transactional trade. International business involves the unique aspect of currency exchange. Everyone is familiar with this concept. After all, seldom do you venture on holiday without visiting your local bureau to get ripped off on the exchange rate and pay a commission on top for the privilege. It might come as a surprise to some people, but international business is no different. Indeed, CFOs wielding mammoth corporate budgets in the billions are no strangers to staggeringly exorbitant fees and wholly unsavory practices employed by unscrupulous currency traders and charlatan institutional investors promising to return a profit. It does one good to remember that fortunes are made and lost with every tick of the Dow Jones Industrial Average, and for every buck you're up, someone's down. Your only hope in this cutthroat business is to offset any potential monetary or financial loss with an equal and opposite financial product, meaning whichever way the wind blows, you're covered. The carry trade exemplifies this technique and can be a lifesaver for budding corporate investors trying to find their feet. The concept of the trade is to borrow money in one country where the interest rate is low, say 1%, then move that money into another currency and deposit it in a foreign bank with a high interest rate, say 8%. You're now making 7% minus whatever you lost in the currency exchange. Providing this can be executed with sufficient financial dexterity, any loss expressed through fluctuating exchange rates will be hedged by the interest rate difference and the resulting profit. Nonetheless, the exposure to local political risk and any ensuing monetary policy changes would be foolish to ignore. Regardless of the spiel investors might be fed to make them part with their money, most financial products, including government-backed securities, derivatives and the underlying markets they're based on, and standard mortgage deals, are fairly blunt instruments that lack subtlety and intricacy due to the plain fact that they need to be understood by the rank and file. Considering privilege and entitlement gives some such an unsurpassable head start in life without merit, it can be said it doesn't take a genius to make money, but to earn it, now that's a different story entirely. These short excerpts are of course just the tip of the iceberg, as there's a lot of language that you can use to discuss business and money. The language and the sentence structure in this introduction should give you an excellent foundation for all levels, especially when speaking and writing. To find out more about learning English for Cambridge and IELTS exams, business and work, or general conversation, visit ParrotandWolf.com.